Welcome back to the deep dive. Today we are tackling a classic financial puzzle. You know the type, the kind of headline that just makes everyone jump to a conclusion. But the real story is, well, it's buried deep in the footnotes. We're doing a deep dive into the Q3 2025 earnings report for Bit Digital Inc. That's ticker BTBT.
And the central mystery here is pretty stark.
It really is. On the one hand, you have this massive headline number. The company reports a net profit of $146.7 million.
A huge number. A spectacular turnaround from the loss they posted last year.
Right. So by any normal logic, you'd think the stock should just skyrocket. That's a huge sign of success.
But it didn't.
Not at all. The complete opposite happened. The stock just plummeted, dropping over 6% in pre-market trading right after they made the announcement.
It's the ultimate paradox, isn't it? You have a 9-figure profit, and the market's reaction is to punish the stock quickly and sharply.
So what's going on here?
Well, this scenario is a perfect masterclass in why you can't trust raw numbers, especially in a sector like digital assets where, the accounting rules can create some really strange outcomes when they collide with volatile commodities.
And our mission for you, the listener, is to move beyond that surface level reaction. We're not here to just celebrate or panic.
Exactly. We're here to solve this mystery. We're going to use a structured 5-part framework to really break down the company's official press release. And we'll integrate that with the crucial external context, which is, real-time market expectations.
So by the end, you'll understand exactly what drove that huge profit, what actually spooked the market into that 6.35% sell-off, and I think most importantly, what the long-term story for Bit Digital really is.
That structure is key to cutting through all the noise here.
All right, let's get into it. Let's start at the surface level, just looking at the performance against last year's numbers. Now for slide 1, the at-a-glance scorecard. So if we just isolate the internal data, right, the year-over-year performance, just Q3 2025 versus Q3 2024, the results, they look genuinely impressive.
They do. On paper, it's a story of significant growth and just a profound financial reversal.
So walk us through what the official company data shows in isolation.
In isolation, it's a picture of massive momentum. You really can't argue with the scale of the improvement. So total revenue for Q3 2025, that came in at $30.5 million.
Okay. And how does that compare?
That's up from $22.8 million in the same quarter last year. So right off the bat, you've got a healthy 33% increase in top-line revenue. That's a strong sign.
A very strong sign. And then we get to that headline-grabbing net income figure.
Right, the big one. The GAAP net income was recorded at $146.7 million.
And a year ago.
A year ago, in Q3 2024, the company booked a net loss of almost $38.8 million.
Wow. So to flip nearly $185 million from a loss to a huge profit, that is statistically dramatic.
It's the kind of swing that, in most other industries, would pretty much guarantee a stock price spike. And this turnaround feeds directly into the metric that shareholders watch so closely, earnings per share, or EPS.
Right.
BTBT reported a diluted EPS profit of 47 cents per share.
Which is a sharp contrast to the 26-cent loss per share they reported just 12 months prior. On the surface, this looks like phenomenal value creation.
It does.
Okay. Before we get to why the market completely rejected that value, let's quickly touch on a key concept, diluted EPS. I know our audience is sophisticated, but it's worth a quick clarification. Why do we always focus on the diluted figure instead of basic EPS?
That's a really critical point, especially for companies in these high-growth tech or crypto sectors. Basic EPS is simple. It's just net income divided by the current number of shares.
Okay.
But companies like Bit Digital often have things like warrants, options, or convertible notes floating around. These could be converted into new stock at any moment.
So they could dilute the value for existing shareholders.
Exactly. Yeah. Diluted EPS forces the company to answer the most conservative question. What would earnings per share look like if every single one of those convertible instruments was exercised and turned into stock today?
It's the worst-case scenario.
It's the worst-case scenario calculation, and it gives investors a much more realistic view of their actual claim on the profits. The fact that BTBT reported 47 cents diluted suggests that even under maximum potential dilution, they were still, by GAAP standards, very profitable.
So on every internal metric, revenue, net income, even conservative EPS, it looked like a home run compared to last year.
The total home run.
And this brings us right to the external context, which is where the score and the story just completely changes. Market expectations versus reality.
And this is where it all shifts from success to pretty severe disappointment. The market is a forward-looking machine. It cares less about how you did last year and much more about how you did against what experts predicted you would do right now.
Let's start with revenue. They reported $30.5 million. Did they beat the analyst estimate there?
They did, but just barely. Consensus estimates from Wall Street were for $30.3 million.
So a tiny beat.
A very slight revenue beat. It's a positive signal, sure, but that small win was, well, it was completely obliterated by the earnings miss.
And this is it. This is the single data point that triggered that 6.35% stock drop. Tell us about the adjusted EPS miss.
This is the critical piece of the puzzle. Remember that 47-cent GAAP EPS profit?
Yep.
Wall Street analysts, they largely ignored it. They were intensely focused on the adjusted or non-GAAP figure, which is supposed to give a clearer view of the company's underlying operational health.
And what did that number show?
Bit Digital reported an adjusted loss of 5 cents per share, negative 0.05.
Loss.
A loss. And this was a catastrophic miss compared to the consensus estimate. Analysts were expecting a very small, almost break-even operational loss of only 1 cent per share.
So, wait, let me just let that sink in for a second. The market was braced for a tiny operational loss, basically break even. And instead, Bit Digital delivered an operational loss that was 5 times bigger than expected.
5 times bigger.
Huh.
Even with the slight revenue beat, something in their underlying cost structure or operational efficiency was far, far worse than anyone anticipated.
So this tiny 4-cent difference between the expected 1-cent loss and the reported 5-cent loss, that single number completely outweighed $146 million in reported GAAP profit.
That is the sheer power of expectations in modern financial markets.
Okay, let's unpack this disconnect. A massive GAAP profit, a 6% stock drop, all because of a 4-cent operational miss. It sounds almost crazy. What does this tell us about what investors actually prioritize?
It teaches us that institutional investors and the algorithms they use, they prioritize the quality and the predictability of earnings far more than the quantity of earnings. They work under the assumption that a big headline profit in this space is almost certainly paper profit.
So they see it coming.
They see it coming. The second that operational loss of 5 cents was announced, it signaled something negative about the core efficiency of the business itself. The cost structure, the margins, something was off. And that information is way more valuable for a long-term valuation model than a non-cash gain that was just driven by the crypto market having a good quarter.
So the market ignored the profit entirely and focused only on the disappointing performance of the business itself.
Exactly. The reaction was rational. They realized the cost structure was growing faster than they'd hoped, and that forced them to discount the entire positive headline.
Which means we now have to go dissect how that $146 million paper profit was even generated so we can really understand why the market was right to ignore it.
That's the next logical step. We have to go behind the curtain and inspect the quality of those earnings. Moving to slide 2, the engine of profitability.
All right, this section gets right to the heart of the paradox. We've established the operational performance was a loss, but the official net income was huge. We need to explain that gap. What was the single biggest driver of that $146.7 million net income?
It was almost entirely external. It was non-operational. The company's own footnotes confirm it. The profit was, quote, largely driven by $146 million in digital asset gains.
That is staggering. So the difference between their total GAAP net income and that non-cash gain is just $700,000.
Just $700,000. So before you even account for other operating losses and adjustments, the core business was barely breaking even. The $146 million was just an accounting rule.
Exactly. This forces us to really dig into the difference between GAAP and non-GAAP accounting, especially for companies holding digital assets. You have to understand this to analyze this sector.
You absolutely do.
So let's start with GAAP, generally accepted accounting principles. Why does U.S. accounting force a company to report a profit on an asset they're holding just because its price went up, even if they never sold it?
So the mechanism is called mark-to-market. Digital assets, especially large reserves like the Ethereum BTBT holds for its staking business, have to be adjusted on the balance sheet every single quarter to reflect their current market price.
Okay.
And in Q3 2025, the market price of the digital assets they held, well, it rose significantly. Because of that rise, GAAP requires them to recognize that increase in value, that unrealized gain, as a non-cash gain right on their income statement.
So to be clear, they didn't sell the Ethereum for $146 million profit.
Not at all. They just held it, and its market price went up by that amount while they were holding it.
So the strong crypto market in Q3 basically created $146 million in paper wealth that the company was forced by law to report as profit.
You got it.
And I want to stress, this is a massive double-edged sword, right? It makes them look great this quarter, but what happens if the crypto market crashes next quarter?
That's the core issue. That's the volatility problem. And it's exactly why institutional investors are so skeptical of this kind of gain. If the crypto market tanks in Q4, the same GAAP rules would force BitDigitals to report an equally massive, catastrophic paper loss and impairment charge on their next income statement.
Which would obscure the actual performance of their real business.
Completely. It creates this extreme non-operational volatility that has nothing to do with how their data centers or staking platforms are actually performing. And investors who want predictability, they immediately jump over to the non-GAAP or adjusted numbers to get away from that noise.
So let's turn to non-GAAP now. This is a voluntary number that management provides to strip out these kinds of misleading items. How does it paint a clearer picture?
The whole point of non-GAAP is to normalize performance. Analysts just want to know, if we take out all the noise from the crypto market swings, is this company actually making money from its core operations?
And that $146 million mark-to-market gain is the first thing to go.
It's the first and biggest thing they strip out. They also typically remove things like one-time restructuring costs or big legal settlements. By taking out that $146 million gain, you immediately see the true state of the business engine.
Okay, so let's do the math here slowly. We started with a GAAP net income of $146.7 million. We take away the non-operational gain of $146 million. That leaves us with $700,000. How does that $700,000 turn into a 5-cent loss per share?
Right. So that $700,000 is what's left after you subtract the cost of revenue. But to get to the true operational picture, the adjusted EPS, you then have to subtract all the core operating expenses required to run the business.
Okay, so things like salaries, office space.
Exactly. General and administrative costs, or G&A, that's salaries, legal fees, and all the substantial costs of scaling up their new business segments. You also have to subtract depreciation and amortization on all their servers and data center gear.
So those operating expenses, the OPEX, were just too high. The $700,000 couldn't cover them.
It couldn't. When you strip away the paper gain, the actual operational expenses they incurred in Q3, the money they spent to fuel the massive growth we're about to discuss, were simply too high to break even. And that shortfall was big enough to push the adjusted EPS all the way down to -5 cents, missing that -1 cent estimate.
This just completely confirms the market's reaction was rational. They saw the big number, they mentally subtracted it, and they were left with a core business that, yeah, it's growing revenue, but it was burning through cash on operations way faster than anyone expected.
It really comes down to a question of scaling efficiency and cost control. Is this a high-growth company scaling efficiently, or is it just throwing money at growth? The market saw that -5 cents and voted for the second option.
Which means we now have to look at the actual revenue segments to see what all that expensive growth is actually buying them. Moving to slide 3, the engine room business segment performance.
Right.
So this is where we shift focus from the short-term accounting noise to the much more interesting long-term strategic story. And the paradox here is that while the operational loss signaled inefficiency, the revenue breakdown actually signals a really successful strategic shift.
It's a profound shift. The key takeaway here is that BitDigital is rapidly transforming its entire identity. And it's not just talk. The Q3 numbers prove it's structurally almost complete.
What do you mean by that?
I mean, if you look at where the revenue is coming from, this is not the same company it was a year ago. The new growth segments, cloud services, ETH staking, and colocation, they now bring in $22.6 million in revenue.
Which is?
That's a massive 74% of their total revenue. This is the new core of the business.
Okay, let's break those down, starting with the new anchor, cloud services. It's now their biggest business line.
By far. Cloud services revenue hit $18 million this quarter. That's 59% of their total revenue, almost two-thirds of the whole company. And crucially, this segment grew by a very strong 48% year over year.
And why is this shift to cloud services so important for a company that used to be a crypto miner? What makes an $18 million cloud business more stable?
It's all about predictability. Cloud services mean contracted recurring revenue. Crypto mining is a commodity business. Your revenue depends entirely on the wild swings of Bitcoin's price, the mining difficulty, energy costs.
Right.
But with cloud services, you're locking customers into contracts to use your computing power. That gives you predictable cash flow and much higher, more sustainable margins. And a 48% growth rate shows there's strong demand for what they're selling.
So that de-risks their whole revenue stream. Now let's look at the growth segment that's maybe even more exciting, ETH staking.
This segment is a perfect example of their strategic pivot. Revenue from ETH staking hit $2.9 million. Now, the absolute number is small, but the growth rate is just phenomenal. It's an explosive 542% year-over-year growth.
500%, wow.
Yeah, up from just $400,000 in Q3 of last year.
And what's the strategic importance of moving from mining Ethereum to staking it?
It's a move from a capital-intensive business to a capital-efficient one. Mining needed tons of expensive hardware, massive energy bills, constant maintenance. Staking just requires you to hold the asset Ethereum and run some relatively low-power validator nodes. It's a much higher margin, predictable revenue stream.
So that 542% growth shows
Right.
they are successfully buying up a lot of Ethereum and putting it to work, generating passive income.
Absolutely. And then you have the new colocation services segment, which brought in another $1.7 million. That shows they're successfully renting out extra space in their data centers.
Okay, so now let's contrast all of this incredible growth with what's happening to their old business, digital asset mining.
And this is where the intentional strategy just becomes crystal clear. The legacy Bitcoin mining business generated $7.4 million in revenue. But this business saw an intentional 27% year-over-year decline.
Intentional.
Intentional.
Mm.
The press release explicitly says this business is in the process of winding down. They are actively shrinking their old, volatile, lower-margin business to reallocate capital and focus on the new, higher-margin platform businesses.
And this detail is so important. I mean, growing revenue by 33% overall is good. But to grow by 33% while you're actively shutting down a $7.4 million revenue stream, that requires just astronomical growth somewhere else.
And the numbers back it up. If you just isolate the new core segments, cloud, staking, and colocation, their combined revenue jumped from $12.6 million in Q3 2024 to $22.6 million in Q3 2025.
Which is
That's a 79% year-over-year growth rate for the future of the company.
79% growth in their strategic businesses? I mean, that's the real headline that was buried in this report.
It is. And it completely reframes that operational loss we talked about.
Right.
That 5-cent miss isn't necessarily a sign of failure. It's more like the inevitable cost of achieving 79% growth while you're also managing a massive wind down. They're in a heavy deployment phase.
But I have to ask the challenging question here. If the new segments are growing so fast at 79%, why did the operational loss get worse than expected? Doesn't that still point to some kind of scaling issue?
That's a brilliant point, and it's the exact question institutional analysts are asking.
Mm.
The miss suggests a few things could be happening. First, the cost of winding down the old mining business might be higher than they budgeted.
Okay.
Second, the upfront cost of scaling a cloud business that's growing at 48% is huge. They're paying for equipment and power contracts now before they see all the revenue. And third, the cloud sector is competitive. They might be spending a lot on customer acquisition to grab market share quickly.
So the short-term financial pain is just the price they have to pay for this rapid strategic shift.
Exactly. They're sacrificing a little bit of efficiency right now for future market share and margin stability. And the big question then becomes, can they actually afford to keep doing this?
Which leads us directly to the balance sheet. Moving to slide 4, financial strength.
Right.
So executing a 79% growth strategy, pivoting the whole company, and covering an operational loss that requires a rock-solid balance sheet. We have to assess their liquidity to see if this strategy is even sustainable.
And the balance sheet gives a definitive answer. It shows that, yes, despite that operational loss, they are fully financed for this pivot. Their financial health is the critical buffer that protects them from that negative market reaction.
What are the key numbers?
As of September 30th, 2025, the balance sheet showed two extremely powerful data points. First, their cash and cash equivalents stood at $179.1 million.
Wow, okay.
And second, their total digital assets were valued at $423.7 million.
So over 600 million in liquid or near liquid assets. This is what we're calling their strategic war chest. Let's break down the cash part first. 179 million in cash. What does that mean in the context of their operational loss?
That cash position is phenomenal for a company this size that's scaling so fast. While we don't have their exact monthly burn rate, we can estimate 179 million in cash likely covers their current high operating expenses for, I'd say, easily 18 to 24 months.
So they have a long runway.
A very long runway. It means they can sustain this high cost, high growth strategy for a long time without financial stress. They have the luxury of absorbing these temporary losses to chase market share.
And that completely de-risks the transformation. If they only had, say, 20 million in cash, that 5-cent loss would be a catastrophe. With nearly 180 million, it's just a line item on their strategic investment budget.
It's the difference between needing to go to the market for more money every quarter and being totally self-sufficient. That cash reserve ensures they can fund their growth building out data centers, buying more Ethereum for staking entirely internally.
Which means they don't have to take on expensive debt or issue new stock.
And that's critical for shareholder value. If they issued new stock, they'd dilute every existing shareholder, shrinking the value of their holdings. This financial strength insulates their long-term strategy from short-term market volatility or, a bad quarter like this one.
Okay, now let's talk about the 423 million in digital assets. We know these drove the paper game, but what is their strategic function? Are they just sitting on them like an investment?
No, it's highly integrated into their new business model. A huge chunk of that 423 million is Ethereum, which is basically the inventory for their ETH staking business.
Okay.
The more Ethereum they own, the larger their staking pool, and the more revenue they can generate from that super high growth 542% segment. It's a productive asset.
And I assume it also acts as a backup financial reserve.
Exactly. If their cash position ever got low, they could liquidate some of those assets to fund their operations or capital expenditures. It's another massive financial buffer on top of their cash.
So it really sounds like management has built a financially bulletproof plan for this transition. Even if they hit a few operational speed bumps, like this quarter's miss, the balance sheet gives them permission to keep going.
That is the perfect summary. The market fixated on the operational loss, but a sophisticated investor would see that the balance sheet completely mitigates the risk of that loss. The financial strength secures the strategic pivot.
Okay, we've analyzed the noise, we've dissected the earnings, reviewed the strategy, confirmed the resources. It's time to put it all together.
Now for slide 5, the road ahead management's outlook and key takeaways.
All right.
So this deep dive has really revealed a story of two coexisting companies, right? The key is reconciling the short-term market perception with the long-term strategic reality.
So let's start with the market's view one last time. We've confirmed their negative reaction was rational. They looked at that $146.7 million GAAP profit and correctly identified it as non-cash, non-operational noise.
Right. They dismissed the noise and they focused on the signal. And the signal was that adjusted EPS loss of 5 cents, which was much worse than the 1 cent loss everyone was expecting. It created short-term anxiety about their scaling efficiency and cost control.
But the bigger and I think far more important story here is the strategic success. This company is executing a complete metamorphosis of its business model.
The proof is right there in the segment breakdown. The new future-oriented businesses, cloud services, ETH staking, colocation, they grew at a staggering 79% year over year. They have successfully shifted from being a volatile commodity miner into a technology platform company.
And, crucially, this whole expensive transition is entirely self-funded and de-risked. That war chest of 179 million in cash and 423 million in digital assets lets them absorb short-term losses and fund their growth without hurting shareholders.
So the final narrative is one of successful transitions. Bit Digital is moving toward a more predictable, contract-based revenue model. That explosive growth in cloud services, which is now their main business, means they're becoming less and less vulnerable to the wild swings of the crypto market.
So that operational loss we saw this quarter, it's really just a symptom of a company in a heavy investment and restructuring mode. It's the cost of rapid transformation, not the sign of a broken business.
It's a classic case of short-term pain for long-term gain. The market, fixated on the quarterly miss, only saw the pain. But our deep dive reveals the extremely high potential of long-term gain.
And here is the final provocative thought for you, the listener, to take away from this. The ability to distinguish between accounting noise and strategic signal is really the highest form of financial literacy. By applying a structured framework like we did today, looking at the headline, dissecting the quality of earnings, assessing the segments, and checking the balance sheet, you can consistently move past those distracting headlines like a huge profit that tanks a stock, and you can identify the true, durable drivers of a company's long-term value.
That framework gives you the clarity you need to navigate these confusing reports. It's an essential tool. Thank you for joining us for this deep dive into BTBT's Q3 2025 earnings.
And before we close, just a necessary note. This report is for informational purposes only and does not constitute financial, investment, legal, or tax advice. The information contained herein is not a recommendation or solicitation to buy, sell, or hold any securities. All investment decisions should be made based on your own research and in consultation with a qualified financial professional. While efforts have been made to ensure the accuracy of the information, no guarantee is provided.
And also, an important AI disclaimer. This report was generated by an artificial intelligence model. It integrates data directly from the company's official earnings press release with publicly available market data obtained via real-time web searches. Although the AI is designed to adhere to strict data sourcing and verification protocols, errors or omissions may still occur. All information, including financial data and calculations, should be independently verified by the user before making any decisions.
Like and subscribe to stockanalytics.ai YouTube channel. Members get access to our library of S&P 500 stocks and NASDAQ 100 library we are building out, and also get priority requests for company deep dives.